Imagine owning a little portion of a global company and receiving compensation for keeping on to it. Sounds intriguing. This is what millions are doing in the stock market. But how does it work? Welcome to the world of stocks and dividends, the driving forces behind investors' financial travels worldwide. You've come to the ideal spot to save for retirement, make additional money, or learn about the buzz. We're simplifying shares and dividends today. After seeing this video, you'll grasp these principles and how to apply them. Let's simplify the stock market and start your financial literacy. Now that we're all in, let's start with stock market investment. Section 1. What is the stock market? Consider the stock market a large farmer's market. Instead of buying fruits and vegetables, investors trade shares, little chunks of firm ownership. Shares are part ownership of a genuine firm with all the rights and rewards that come with it. Public corporations publish their shares in this marketplace, making them open to everyone from institutional investors to beginners. Why do firms list shares? It's simple. Fundraising is the goal. Selling shares to the public can replace bank loans. This gives them capital to develop, and you, the shareholder, benefit if the firm succeeds. Every day, millions of shares are traded on stock exchanges worldwide, from New York to Tokyo. Intermediaries like these exchanges make buyer-seller transactions easy. That's only the start. In the next section, we'll explain shares, their kinds, and how they affect investors. Ready to examine the stock market's foundations. Discuss shares. Section 2. 101 Shares. Let's focus on shares. When someone says they own stock in a corporation, they mean shares. But what does that mean? Shares symbolize firm ownership. Shares are like pizza slices if a corporation were a pizza. Buy a share to get a piece of the company's assets and profits. You're becoming a firm owner, whatever tiny your share. Now, there are primarily ordinary and preferred shares. Shares are common. We'll discuss dividends and shareholder meetings later. Preferred shares differ. Consider them VIP shares. They tend to have more vital assets and profit claims, but no voting rights. Companies distribute dividends to preferred shareholders before regular stockholders. People buy shares. Why? Some acquire them for dividends, some for voting rights, and many for future growth. If the firm does well, you may sell your shares for a profit. Many investors aim for it, but it's not just choosing a firm and buying shares. It's essential to analyze the company's performance, industry, and economy. All these variables impact share value. After explaining what shares are and why they're important, let's examine how they acquire value and what that implies for you. Section 3. Share value. Investors must comprehend how shares gain value. How can a share move from a few dollars to hundreds of dollars or thousands? What investors pay matters. Share prices depend on corporate performance, investor sentiment, and market conditions. Let's start with performance. People desire to acquire shares in profitable, promising companies. Demand raises share prices. Popularity increases value, just like any other commodity. Market capitalization. Market caps is another common word, the worth of all company shares. Multiply the share price by the total number of shares. This shows a company's size and value compared to others. Stock indexes include the S&P 500 and Dow Jones Industrial Average. These stocks reflect a market segment. The market is up today typically indicates these indices are up. They're good market indicators. Remember, share prices don't always rise. It can fall too. Herein lies the risk. Share prices change with profits, economic data, politics, and more. As an investor, you must realize that share prices can fluctuate fast. After understanding share value, let's discuss dividends, which can increase share value and give a steady income. Part 4. Explaining dividends. Let's address dividends, which attract many investors to stock investment. A corporation distributes earnings to its shareholders as a dividend. A corporation might reinvest profits or pay shareholders a dividend. Most dividends are paid in cash and per share, so the more shares you hold, the bigger your dividend distribution. Companies, especially young ones, may refrain from paying dividends, preferring to reinvest all revenues to develop. Dividends go beyond cash. They indicate a company's health and maturity. Dividend payments can show financial stability and profitability. However, a high dividend yield A high payout proportion to the share price may indicate that the market doubts the company's growth prospects. Instinct to remain stock dividend. Shareholders receive more stock instead of cash. Dividends can be reliable, but not guaranteed. Financially struggling companies can slash payouts. Understanding dividends is essential to stock income investing. Dividends are simply one factor. Here's how to generate money with shares and dividends and what tactics can meet your financial goals. Section 5. Profiting from shares and dividends. Wealth creation in the stock market relies on capital appreciation and dividends. Break them down. Share value gains represent capital appreciation. If the firm succeeds, demand for your shares rises, raising their price. You earn by selling shares at this more excellent price. Classic buy low, sell high. Stocks may be volatile. Many factors, including market emotion, cause price fluctuations. Thus, many investors want dividend income. In turbulent or down markets, dividends can provide a stable income independent of share price swings. The dividend reinvestment plan, DRIP, is also influential. Instead of receiving dividends in cash, you automatically acquire more business shares. This may compound growth as you hold more shares and earn more dividends, which can purchase more shares. Stock investment is always risky. Your shares may lose value, and corporations may stop paying dividends. A diverse portfolio is essential. Diversifying your assets across firms and industries reduces risk. With these techniques, you may be asking how to begin. First stages to stock market investment. Section 6. Stock market entry. It may sound intimidating, but stock market entry is easier than ever. How to start investing? First, open a brokerage account, your portal to purchasing and selling shares. Today, there are several beginner-friendly internet brokers. Consider fees, research tools, and usability while deciding. After setting up your account, complete your research. Before buying shares in a firm, learn about its operations, revenue, and growth possibilities. Research helps here. Study financial news, corporate reports, and market trends. There needs to be an alternative for diligence. Better investing decisions come from more excellent knowledge. Stunting for fast winners is tempting, but the stock market is long-term. Patience and discipline usually work best. You can become an intelligent investor now that you understand shares, dividends, and how to start. Learning shouldn't end here. Much has been covered today. Shares are purchased and sold on the stock market, making you a part owner of a corporation. We examined how shares may appreciate and how dividends can be reinvested or used to build your holdings. Remember, buying in stocks isn't simply about fast cash. It's about educated judgments, knowing risks, and having a clear plan, whether that's long-term growth, dividends, or both. Learn while you travel on this exciting tour. Staying educated is essential in the volatile stock market. Read literature, track markets, and consult a financial counselor. Finally, invest wisely, not overly. Know your risk tolerance and never invest money you can't lose. Suppose you liked this video. Like and subscribe for more financial advice. Have questions or topics for us to cover? Comment below. Continue your financial education till next time. Thank you for watching.